We've seen some big moves in key commodities as Trump's tariff policies rattle the markets. Joining us now to discuss where we could be headed is Hussein Aladina, Managing Director and Head of Commodities at TD Asset Management. Hussein, always great to have you back on the program.
Thanks for having me.
Interesting times, lots going on, hard to keep up. I know you've been keeping up on the commodities side. Give me a bit of a context here as to what we're seeing and what it can mean for the bears and the bulls.
Yeah, so it has been, a exciting week, probably exciting year. If I'm being honest. We had obviously over the weekend quite a bit of noise around potential tariffs on both Canada and the U.S. Sunday night, oil opened up 3-4% on that news. I think that obviously the tariffs are not in place at the moment, at least for the next 28 days. To the extent that the U.S. tariffs Canadian and/or Mexican energy, we think that's constructive for WTI, for Brent. It's not bullish for Canadian crude. We saw on that news Western Canada Select, the marker out west, fell. We've been averaging probably 12, 13 under WTI. On that news, it traded as low as 17. But as it relates to WTI, as it relates to Brent, which are the commodities that are in most commodity indices, we think it's constructive. The U.S. takes roughly 4 million barrels a day of crude imports from Canada. That's not easy to replace, particularly if you are also sanctioning Mexican crude. Without getting into, too much nuance, Canada and Mexico produce a medium, heavier, sour crude oil. The U.S. produces light sweet crude. That's what comes out of the Permian, that comes out of the shale. And refineries in the U.S., refineries globally, have been run on a sort of medium-ish basket API of crude. You can't just replace Canadian crude with U.S. crude, even if U.S. crude production grows. You're not going to grow by 4 million barrels a day. Even if you do grow by 4 million barrels a day, it's a different type of crude. So we talk about crude as though it's homogeneous. It's not homogeneous at all. And refiners in the U.S., particularly in PADD 2, PADD 4, the middle of the country, have been optimized to run on this mix of Canadian, U.S. blended together.
Now, of course, we're seeing ebbs and flows from day to day based on what's happening. And as you said, we don't know what's going to happen in 28 days. That sounded like some constructive things there on the crude file. What about some of the more bearish?
Yeah, so again, there's some speculation here, but in an environment where the U.S. is sanctioning, for example, China, the 10%, the last time President Trump was in office and he sanctioned China, China responded by not taking U.S. soybeans. The U.S. is the largest exporter of soybeans, one of the largest exporters behind Brazil globally. If China decides to retaliate to U.S. tariffs by not taking beans, that's bearish for grains. Depending on how severe the sanctions get with China, with Mexico, with Canada, with potentially Europe, it's bearish for commodities to the extent that it's bearish for growth. If we end up in an environment where growth disappoints, that's going to impact commodity demand, all else equal, and that's not good for the commodity. Having said that, and we've talked about this before, I think we have to appreciate where we are in the commodity cycle. And Greg, the truth is that for the better part of the last 12 years, we've discouraged commodity supply. Last year, even though we didn't have phenomenal growth, China was, materially weaker than expected. Europe was weak. We talked about hard landing, soft landing at different points throughout the year. Notwithstanding all of that, commodity balances tightened. Commodity returns were positive last year. And again, I think this underscores the lack of investment that we've seen on the supply side. Absent the tariff noise, if you believe that GDP growth is still going to continue to increase, which is our base case, that portends to positive commodity returns given how challenged the supply side is.
Nice rundown on oil. Some other commodities, of course, gold. You and I talk about gold a lot. Keeps just moving higher into record territory. What's underpinning this? Because the U.S. dollar has been going higher too, and from when I was a schoolboy, I was told those things wouldn't happen.
Yeah, so historically, and this is interesting for gold, it's interesting for commodities as a whole, right? We've seen tremendous dollar strength, and notwithstanding the fact that you've seen that tremendous dollar strength, commodities have posted 5-6% positive return last year. Gold is really, really interesting. You're absolutely right. What they taught you in school, typically higher real rates and a stronger dollar is bearish for gold. We've talked before, but if you look at what emerging market central banks have been doing, and doing in a sort of pronounced way since the U.S. confiscated Russian reserves, these EM central banks, not just China, but EM central banks broadly, have been diversifying away from fiat, mainly the US dollar, and buying gold. I think the last time I was on, we talked about how retail demand for gold had been relatively lackluster, and that's because as a retail investor, I'm faced with buying gold, which doesn't yield or pay a dividend, or buying equities, and last year equities were up 20+%. I argued then, and I still have the view now, that if we see some anxiety, some heartburn in equities, there's a lot of gold to be bought by the retail community and the institutional community. There's a handful of institutional investors that hold gold. I'd argue that the smarter ones appreciate the value that gold provides in the portfolio. I think there's still a lot of tailwind ahead for gold, if I'm being honest.
Let's talk about the position of commodities more broadly in a portfolio. You talked about a place for gold in the portfolio. We talked about oil. We talked about some other things. How should an investor be viewing that?
Yeah, so if you look at academic work, if you look at work that we've published out of our research group at TD Asset Management, and you do a optimization on your portfolio, if you're trying to build a portfolio that has the highest sort of Sharpe, the highest risk or highest return for a given level of risk, you want to include a commodity allocation, not commodity equities, commodity the derivative, and that optimal allocation, depending on what your starting portfolio looks like, is somewhere between 5 and 10%. Now that work, or that 5 to 10%, comes from an analysis over time. Over time, commodities average above the cost of production, below the cost of production. We believe that given where we are in the commodity cycle, we're going to see commodity returns on average perform better than they have kind of through the cycle as a whole. Because through the investment phase of the cycle, you have to encourage CapEx and supply, which we haven't been doing in the last 10 years, and that's why balances today are tight. I think investors should have no less than 5% and higher, given the environment that we're sitting in today. Uncertainty around inflation is good for the commodity, right? Commodities are the one asset class that has positive beta or responds positively to higher inflation. And then, of course, if we think about, some have argued that, depending on how extreme tariffs get, you could end up in a stagflationary environment. Equities don't do phenomenally well in stagflation. Fixed income doesn't do well. Commodities do well. So I think there's, strategically or structurally, there's a benefit of having commodities. I think that incentive or that motivation is higher today than it has been at any point in the last 10 to 15 years.